Hello, I'm Tom Foster, Tax Director at Lewis Brownlee. We frequently get asked about capital gains tax, so I thought it'd be helpful to summarise the main principles of this tax. Essentially, it is a tax on the change in value of asset during a person's ownership. As such, it might not necessarily be driven by the purchase consideration or sale consideration received, because in the eventuality of an asset being gifted, it will be for market value, which determines what the gain was during a person's ownership. So a starting point as well, again, would be for market value when an asset first passes into an individual's ownership, perhaps via inheritance or as a recipient of a gift. So the gain itself is a change in value during the ownership. Against that, you are able to deduct costs that are incurred during the process of buying or selling the asset. You can also claim for costs that are incurred which actually improve the asset, so enhance its value. We typically would see this with properties, for instance, maybe if an extension is built or some significant upgrades are introduced. There is, however, sadly, no relief at all to take into account inflation. So it very much is simply the change in value of the asset during ownership that counts. There are some exemptions for capital gains tax. Not all assets are assessable, such as personal possessions worth under £6,000. Exemptions also apply when gifts are made to a spouse or a civil partner, and assets held in an ISA are also exempt from tax. The tax doesn't apply to wasting assets which depreciate in value, such as a typical car. However, be mindful here, because some cars, such as classic cars, actually do appreciate in value and so could be liable to the tax. Once a gain has been determined, we have to establish to what extent a tax liability would arise. There is an annual exemption, and for individuals, this is £3,000. Sadly, this exemption has been significantly reduced in recent years. Not so long ago, it was £12,300. But what that means is it doesn't take much now to sell an asset and trigger a tax liability. Gains over £3,000 could be taxed at anything from between 10% to 28%. The applicable tax rate depends on the nature of the asset and how much income the individual receives. 10% rate might typically apply to certain business assets by virtue of qualifying for business asset disposal. These are subject to qualifying conditions such as a holding period of 2 years and the asset being a qualifying business interest, generally being one that the person actually worked in. Residential property would be subject to tax rates of 18% at the basic rate and now 24% at the higher rate. Some gains can be held over, such as gifts of business assets. Relief is available for losses, which can be offset against gains incurred in the same tax year or a later tax year. In some instances, such as losses incurred on shares in unquoted trading companies, it's possible to offset those losses against income. Gains which give rise to tax liabilities have to be reported on the self-assessment tax return. There is also a double reporting requirement when selling residential property, as there's now a requirement to submit residential property returns within 60 days of the date of conveyance, at which time the tax has to be paid. For gains on other assets, such as shares, the tax is payable on the 31st of January following the end of the tax year in which a disposal occurred. Capital gains tax also applies to non-residents when selling residential property, or if an individual is caught by anti-avoidance rules, such as selling assets while regarded as being temporarily non-resident. To summarise, we're always happy to advise, calculate gains and prepare returns, so please do contact us if you need any help.